Before we begin, a very important disclaimer. I am not a financial advisor, and this presentation does not constitute financial advice. The content in this video is for educational and entertainment purposes only. Investing involves risk, including the potential loss of principal. You should always conduct your own research and consult with a licensed professional before making any investment decisions. Your financial situation is unique, and any action you take based on the information in this video is strictly at your own risk. There are two economies in America right now. In the first economy, you work a job, you get a paycheck, you put some money in a savings account, and every single year your money is worth less than it was the year before. A silent tax called inflation is quietly stealing your future. In the second economy, your money works for you. It grows while you sleep, it compounds, and it builds real lasting wealth. The door between these two economies is the stock market. And for most people, that door looks locked. You see the headlines. You see the crazy charts going up and to the right. You hear stories about tech stocks doubling overnight. And you feel a mix of confusion, envy, and a deep-seated fear of missing out. You look at your own bank account, maybe you've saved up your first $1,000, and a voice in your head says, "That's not enough to even matter." Or "It's too complicated, I'll just lose it all." Or, "That's a rich person's game." That feeling, that paralysis, is the single most expensive feeling you will ever have. It's more destructive than any market crash. It's the gap between the life you have and the life you could be building. This video is the key to that locked door. Over the next few minutes, we are going to systematically dismantle every fear and every myth that has kept you on the sidelines. My promise to you is simple. By the end of this video, you will not only believe that you can invest your first $1,000, you will have a crystal clear understanding of why you must, and you'll be armed with the foundational knowledge to do it intelligently. We're not going to talk about day trading or crypto or any get-rich-quick nonsense. We are going to talk about a timeless, proven strategy for building wealth by owning a piece of the greatest companies in the world. So let's start by taking a sledgehammer to the 3 giant myths that are keeping you from building wealth. Myth number 1. I don't have enough money. $1,000 is nothing. This is the biggest lie we tell ourselves. 20 years ago, this might have been true. You needed to call a guy in a suit, a stockbroker, who would charge you a $100 commission just to place a trade. You had to buy whole shares of a stock, and if Amazon was trading at $2,000 a share, well, you were out of luck. Today, that world is ancient history. Technology has completely democratized investing. Because of something called fractional shares, you can now buy a small slice of any company for as little as $1. You want to own a piece of Apple but don't have $180 for a full share? No problem. You can buy $10 worth, or $5 worth. You instantly become a part owner of Apple, and your $5 will grow at the exact same percentage rate as a billionaire's $5 million investment. Your first $1,000 isn't nothing. It is a launch pad. It is the seed from which a giant financial tree can grow. Every single wealthy investor you can think of started somewhere. Most of them started with less than you have right now. The key isn't the amount you start with. It's the act of starting itself. Myth number 2. It's too complicated. I'm not a math genius. Does investing seem like a foreign language? Full of weird acronyms like ETF, S&P 500, and Roth IRA? It's designed to feel that way. Wall Street loves to use complicated jargon because it makes them seem smarter and allows them to charge you massive fees to manage your money. But here's the truth. The basics of smart, long-term investing are incredibly simple. In fact, they're far simpler than most things you've already figured out in your life. Think about learning to drive a car. First, it's overwhelming. You've got the steering wheel, 2 or 3 pedals, a gear shift, mirrors, turn signals, and you're trying to navigate traffic. Feels impossible. But what do you actually use 99% of the time? The gas, the brake, and the wheel. Investing is the same. There are thousands of complex strategies out there, but for 99% of people, all you need to know are the gas, the brake, and the wheel. And in this series, I'm going to show you exactly what they are. You don't need an MBA. You don't need to read the Wall Street Journal every morning. If you can order something online, you have all the technical skills you need to start investing. We're going to cut through all the noise and focus only on what you actually need to know to get started safely and effectively. And that brings us to the most dangerous myth of all. Myth number 3. The stock market is just gambling. It's like a casino. This is a fundamental misunderstanding of what you're actually doing when you invest. When you go to a casino and put money on a roulette wheel, you are betting on a random outcome. The house has a mathematical edge, and over the long run, the house will always win. You are not creating any value. You're just hoping to get lucky. When you buy a stock, you are not gambling. You are buying ownership. Let that sink in. You are purchasing a small fractional piece of a real, living, breathing business that sells actual products or services to real people. When you buy a share of Apple, you own a tiny piece of every iPhone, every MacBook, and every App Store transaction. When they make a profit, you, as an owner, are entitled to a piece of that profit. Imagine you owned a tiny slice of the most popular coffee shop in your town. Every time they sell a latte, you're making money. If they get more popular and expand to another location, the value of your ownership stake goes up. You're not betting on a random number. You're partnering with a successful business. The stock market is just a collection of the biggest and best coffee shops in the country and the world. You're not gambling on them. You are investing in their future success. Yes, on any given day, the price might go up or down based on news and emotion. That's the short-term noise. But over the long term, the value of great companies tends to go up, because the American economy, for all its ups and downs, has an incredible track record of innovation, growth, and creating value. Gambling is a bet on chance. Investing is a bet on human ingenuity. They are not the same thing. So let's recap. You do have enough money to start. It is not too complicated for you to understand. And it is absolutely not gambling. So why is this so urgent? Why do this now? Because of that silent thief I mentioned earlier, inflation. Right now, the money in your savings account is like a block of ice on a hot day. It's melting. Every day it's a little bit smaller in terms of what it can actually buy you. A savings account is a guaranteed way to lose money over time. Investing is your only defense. It's how you put your money into an environment where it has the potential to grow faster than it's being devalued. It's not about getting rich quick. It's about not getting poor slowly. It's about taking your $1,000 today and turning it into a future where you have options, freedom, and security. It's about finally moving from the economy where you work for your money to the one where your money starts working for you. And that phrase, money working for you, gets thrown around a lot. But what does it actually mean? Imagine two friends both earn the same salary. Let's call them Alex and Ben. Every month, Alex takes $100 and puts it under his mattress. He feels smart. It's safe. It's simple. Ben also takes $100, but he uses it to buy a tiny fraction of a successful company. A company that makes things people buy every day. For the first few years, it doesn't look like much. Alex has a growing pile of cash. Ben has a number on a screen that wiggles up and down. Alex even makes fun of Ben during a market dip, saying, "See? I told you. You're just gambling." But Ben understands something Alex doesn't. Alex's money is sleeping. Ben's money is at work. It's in a factory, it's funding research, it's part of every sale the company makes. It's earning its keep. 10 years go by. 20 years go by. Alex opens his mattress and finds his pile of cash. It's all there. But when he goes to the store, he's shocked to find that his pile of cash buys less than half of what it used to. It got eaten alive by a silent thief. Ben, on the other hand, looks at his account. That wiggling number has grown, and grown, and grown. It's not just the original $100 a month. It's the growth on that $100 and then the growth on that growth. It's a snowball rolling downhill, getting bigger and faster all on its own. Ben isn't just a saver. He's an owner. And that is the single most important mindset shift you need to make with your first $1,000. You're not just putting money away. You are shifting from being a consumer in the economy to being an owner of the economy. Now, the biggest lie we've been told is that this world of ownership, this world of investing, is reserved for the guys in suits on Wall Street. That it requires a secret language, a math degree from MIT, and a crystal ball. That is a myth. A myth designed to keep you on the sidelines, to keep you as a consumer, to keep you working for your money instead of the other way around. The truth is, the tools and knowledge to become an owner are more accessible today than at any point in human history. They're sitting right there on the phone in your pocket. The real barrier isn't complexity, it's fear. And that fear is fed by two giant misunderstandings. First is the fear of losing your money, and second is the paralysis of not knowing where to even begin. We are going to dismantle both of those fears right here, right now. Let's start with a bigger risk than investing, the risk of not investing. Remember Alex and his cash under the mattress? The silent thief that robbed him is called inflation. You hear this word on the news, but let's make it real. In the year 2000, the average price of a new car was about $22,000. Today, it's over $48,000. It's more than doubled. A gallon of milk, a movie ticket, a college textbook. The prices of almost everything consistently go up. This isn't a theory. It's a fundamental rule of our economy. The government is literally designed to create about 2 to 3% inflation every single year. So if your $1,000 is sitting in a checking or savings account earning 0.01% interest, you are not standing still. You are on a downward escalator. You are guaranteed to be losing purchasing power every single day. Your money is getting weaker. Leaving your first $1,000 in cash isn't the safe option. It's the guaranteed to lose option. Investing isn't about taking a wild risk. It's about protecting your money from the certainty of inflation. It's about getting your money onto the upward escalator of economic growth. Now for the second, even more costly mistake, waiting. Procrastination is the most expensive financial decision you will ever make. More costly than any market crash. Let me prove it to you with the single most powerful force in finance: compound interest. Albert Einstein supposedly called it the eighth wonder of the world. He who understands it earns it. He who doesn't pays it. Let's go back to our two friends. We'll call them Sarah and Mike. Sarah is 25. She scrapes together her first $1,000 and invests it. For the next 10 years, she adds just $100 a month. At age 35, she stops. She never adds another dime. She just lets that money sit there and grow in the stock market. Her friend Mike is also 25, but he says, "I'll start later. I'm young. I want to have fun." So he waits. At age 35, the same age Sarah stopped, Mike gets serious. He says, "Okay, I'm going to catch up." He invests his first $1,000, and he starts adding $100 a month. But unlike Sarah, he doesn't stop. He keeps adding $100 a month every single month, all the way until he's 65. So let's recap. Sarah invested for just 10 years from age 25 to 35. Mike invested for 30 years from age 35 to 65. Who do you think ends up with more money at retirement? It's not even close. Assuming a historical average stock market return of about 10% per year, Mike, despite investing 3 times as much of his own money over a much longer period, would have around $330,000. Not bad. But Sarah, the one who started early and stopped, she'd have over $600,000. Almost double. Let that sink in. She invested less money for less time and ended up with twice as much. Why? Because her money had more time to work. Her $1,000 had an extra 10-year head start to compound, to grow, and to have its own babies, which then had their own babies. The money she invested in her 20s was infinitely more powerful than the money Mike invested in his 40s. That is the cost of waiting. Every day you wait, you are giving up the most valuable asset you have as an investor: time. Your first $1,000 isn't just $1,000. It is a seed. And the sooner you plant it, the larger the tree it can grow into. Waiting until you have $10,000, or until you know more, or until the market feels right is a trap. The perfect time to start was yesterday. The next best time is right now with what you have. So we've established that not investing is a guaranteed loss to inflation, and waiting is a catastrophic mistake. The logical conclusion is that you need to put your $1,000 to work in the American stock market. But what even is that? Forget the charts, the jargon, the flashing red and green numbers. It's much simpler. The stock market is just a place where you can buy ownership in the biggest, most successful companies in the country and in the world. When you buy a stock or a share, you are literally buying a tiny piece of a real business. Do you have an iPhone? You can own a piece of Apple. Do you drink Coca-Cola? You can own a piece of the company that makes it. Do you shop on Amazon? You can own a slice of that empire. You are already a customer of these companies. You already give them your money every single day. Investing is just the decision to stop being only a customer and start being an owner. To get a piece of the profits that you yourself are helping to create. When Apple sells a new iPhone, as an owner, a tiny fraction of that profit belongs to you. When millions of people buy a latte at Starbucks, as an owner, you get a piece of that. You are hitching your wagon to the engine of American capitalism. You are betting on the long-term success, innovation, and hard work of hundreds of thousands of people. It's the most powerful wealth creation machine in the history of the world, and for the first time ever, you can access it with just a few taps on your phone. This is the mindset. Your first $1,000 isn't a lottery ticket. You're not trying to pick the next meme stock that goes to the moon. You're not gambling. You are buying a stake in the collective success of the American economy. You are becoming a capitalist in the truest sense of the word. Okay, so the mission is clear. We need to fight inflation. We need to harness the power of compound interest by starting now. And we're going to do it by becoming owners of great American companies. The big question remains, how? How do you actually do it? What's the first practical physical step you need to take? What account do you open? What button do you press? Where does that $1,000 actually go? That's the bridge we're about to cross. We're moving from the why to the how. In the next part, I'm going to walk you through step by step, the single best, easiest, and cheapest way to open your first investment account. We'll cut through all the confusing options and I'll show you exactly what to choose and why. We're about to turn this abstract idea into a concrete reality. And that reality starts with choosing a place to put your money. Not a bank, but something called a brokerage. Think of a brokerage account as a special kind of wallet. Your normal bank account holds your cash for groceries and rent, but a brokerage account is the wallet you use to hold your investments, your pieces of companies, your shares of stock. It's the secure digital vault where your wealth will live and grow. Now, if you type best brokerage account into Google, you'll be hit with a tidal wave of options. You'll see names like Fidelity, Vanguard, Charles Schwab, E-Trade, Robinhood, Webull, M1 Finance. The list goes on. And right here, this is the first wall that stops most people cold. It's called analysis paralysis. You have so many choices that you can't decide, so you do nothing. You close the tab and say, I'll figure it out later. But we are not doing that today. We are going to smash right through that wall. I'm going to make this incredibly simple for you. Out of that entire universe of options, we are going to focus on only three. The three titans of the industry. The ones your grandparents trust, but with modern technology that makes them perfect for us today. Those three are Fidelity, Vanguard, and Charles Schwab. Why these three? Why not the flashy new apps with the cool marketing? Because we aren't trading. We are investing. We are building long-term wealth. And for that, you want a fortress. You want an institution that has been around for decades, that manages trillions with a T of dollars, that has rock-solid security, and that has 24/7 customer service you can actually call and speak to a human being if something goes wrong. These three check every single box. More importantly, for our purposes, they are all essentially free. Let me repeat that. To open an account and to buy the kinds of investments we're going to talk about, it costs you $0. No account fees. No trading commissions. This is a revolution in investing that's happened over the last decade. In the past, you had to pay $100 just to make a single trade. Today, the doors have been blown wide open for everyone, and these three companies led the charge. So, out of Fidelity, Vanguard, and Schwab, which one do you pick? Honestly, you could close your eyes, point at one, and you would be making a fantastic choice. They are all A+ options. The difference between them is like the difference between a Coke, a Pepsi, and a Dr. Pepper. They're all great sodas, you just might have a slight personal preference. Vanguard is the OG, the original pioneer of low-cost investing for the people. Their website can feel a little dated to some, but it's unbelievably powerful and trusted by millions. Schwab and Fidelity are very similar. They offer a massive range of services, fantastic research tools you'll grow into later, and their websites and mobile apps are incredibly slick and modern. So, to destroy any last bit of indecision, I'm going to make the choice for you. If you want my direct, personal recommendation for a beginner in the United States today, it's Fidelity. Why? Their technology is top-notch, the mobile app is clean and easy to use, their customer service is legendary, they have zero fees for what we need, and they offer a feature called fractional shares for almost everything. This means you can invest with as little as $1. You don't need to buy a full share of something. You can buy a tiny slice, which is perfect for someone starting with their first $1,000. So here's the action plan. You're going to open a new tab, go to fidelity.com, and click the big button that says, Open an account. Now, you're going to need to provide some personal information. This part sometimes makes people nervous, but it's a legal requirement. You'll need your social security number, a government-issued ID like a driver's license, your address, and your employment information. Brokerages are regulated just like banks. They are required by federal law, specifically the Patriot Act, to verify your identity to prevent things like money laundering and terrorism financing. This is for your protection and the protection of the entire financial system. It's a standard secure process. You will then be presented with the single most important choice you will make in this entire process. It will ask you, what type of account do you want to open? You're going to see a list of confusing options. An IRA, a 529, a solo 401k, an HSA. You will ignore all of them except for two. Your choice will be between a standard brokerage account, sometimes called a taxable brokerage account, and a Roth IRA. This is a critical distinction, so listen closely. A standard brokerage account is the most straightforward. You put money in from your bank. You buy investments. If they grow in value and you sell them a year later, you pay capital gains tax on the profit you made. It's simple, it's flexible, and you can take your money out whenever you want. But the Roth IRA? The Roth IRA is a financial superpower. It's a special type of retirement account that the US government created to encourage people to save for the future. And it has one magical rule that can make you hundreds of thousands or even millions of dollars richer over your lifetime. Here's how it works. With a Roth IRA, you put in money that you've already paid taxes on, your normal paycheck money. That money goes into the account, you invest it, and it grows. It might double, triple, or grow by 50 times over the decades. And when you pull that money out in retirement at age 59 and a half or later, all of that growth, every single penny of profit, is 100% tax-free. Let me paint a picture for you. Let's say you and your friend both invest $1,000. You put yours in a Roth IRA. Your friend puts theirs in a standard brokerage account. You both buy the exact same investment, and you both let it grow for 40 years. Turns into, say, $50,000. When your friend goes to withdraw their money, they'll have to write a big check to the government for taxes on their $49,000 of profit. That could be $7,000, $8,000, maybe $10,000 or more gone. But you? When you withdraw your $50,000, you get to keep all of it. The government can't touch it. It is an almost unbelievable advantage. Now there are some rules. The government limits how much you can put into a Roth IRA each year. It's currently $6,500 for most people. And it's designed for retirement, so if you try to pull the earnings out before you're 59 and a half, there can be taxes and penalties. But you can always withdraw your original contributions, what you put in, without any penalty. So what's the verdict? For your first $1,000, if you have earned income and you qualify, the single best place for it is a Roth IRA. Starting this account now, in your 20s, 30s, or even 40s, is the biggest gift you can possibly give your future self. It is a government-sanctioned cheat code for building wealth. So on the Fidelity page, you will select Roth IRA. You'll go through the final steps, agree to the terms, and just like that, you are the proud owner of an investment account. You have a place for your money to grow. The final step is to fund it. The website will prompt you to link a bank account. You'll enter your bank's routing number and your account number. Just like setting up direct deposit for a job. You'll then tell it to transfer your $1,000 from your checking or savings into your new Fidelity account. This usually takes 1 to 3 business days to clear. It's secure, it's electronic, and it's simple. And then you're there. The account is open. The $1,000 is sitting there as cash, waiting for your command. You've done what millions of people only talk about doing. You've taken action. Now comes the most exciting part. Choosing your very first investment. In the next part, we are going to demystify the stock market itself, and I will reveal the single best, most powerful investment for 99% of beginners. You're not just going to buy a stock. You're going to buy the entire American economy with a single click. So let's talk about what the stock market actually is. Because for most people, it's this big, scary, abstract casino in the sky. It's flashing numbers, confusing charts, and men in suits yelling on a trading floor. Forget all of that. That's the Hollywood version. The reality is much simpler and, frankly, much more beautiful. I want you to picture a giant, sprawling farm, the Great American Farm. This farm has thousands and thousands of different plants growing on it. Some are massive ancient oak trees that have been there for decades, providing shade and stability. Think of companies like Coca-Cola or Johnson & Johnson. They're strong, reliable, and not going anywhere. Then you have fast-growing fruit trees. These are your tech giants. Your Apples, your Microsofts, your Amazons. They exploded in growth and now produce a massive harvest every single year. You also have smaller, newer saplings being planted all the time. These are the startups, the exciting new companies. Some of them will wither and die before they ever bear fruit. But a few might just grow into the next giant oak or the next apple tree. Now, each of these plants, each tree is a publicly traded company. And buying a stock is simply buying a single seed from one of those specific plants. If you buy a share of apple, you own a tiny microscopic piece of that massive fruit tree. When the tree does well and its fruit is valuable, the value of your little piece goes up. If the tree gets a disease or has a bad harvest, the value of your piece goes down. Now, the old way of thinking, the Wall Street way, was that your job as an investor was to be a master botanist. Your job was to walk around this entire massive farm and analyze every single leaf, every branch, every root system, and try to predict which one specific plant was going to grow the fastest next year. Does that sound hard? It's not just hard, it's nearly impossible. Even the professionals, the people who spend 80 hours a week with teams of analysts and supercomputers, get it wrong all the time. They might bet the farm, so to speak, on a new sapling they think is the next big thing, only to watch it get eaten by insects and die. Remember companies like Blockbuster or Enron? Those were once prize-winning plants on the farm. Now they're just dust. Trying to pick individual stocks as a beginner is a recipe for disaster. It's stressful, it's time-consuming, and it's how most people lose money and swear off investing forever. They bet their first $1,000 on one or two hot tips they heard about. And when those specific plants wither, they conclude that the entire farm is a barren wasteland. But what if I told you there was a different way? What if, instead of trying to be a genius and pick the one winning plant, you could buy a single magical seed packet? And inside this packet wasn't a seed for one plant, but a tiny, tiny sliver of a seed from every single one of the biggest and best plants on the entire farm. With this one magic seed packet, you would own a piece of the sturdy oak tree. You'd own a piece of the fast-growing apple tree. You'd own a piece of the reliable corn stalks, the innovative new soybeans, everything. Now, if one of those plants has a bad year, does it matter to you? Not really. It's just one tiny part of your massive collection. If one of the saplings dies off completely, who cares? The growth from all the other healthy, thriving trees will more than make up for it. You are no longer betting on a single plant. You are betting on the success of the entire farm. As long as the farm as a whole continues to grow, get sunshine, and produce a harvest, which the American farm has done for over a century, so will your investment. This magic seed packet isn't a fantasy. It's real. It's called an index fund. And the single best one for 99% of beginners is an S&P 500 index fund. Let's break that down. The S&P 500, which stands for the Standard & Poor's 500, is simply a list of the 500 largest and most profitable public companies in the United States. It's a who's who of American business. We're talking Apple, Microsoft, Amazon, Google, Tesla, Berkshire Hathaway, Johnson & Johnson, Visa, Walmart, Home Depot. These are the giants, the titans of industry. They are the biggest, strongest plants on the entire farm. An S&P 500 index fund is a fund that automatically buys and holds stock in all 500 of those companies for you. So when you invest just $1 into an S&P 500 index fund, that dollar is automatically split up and invested across all 500 of America's top companies. You instantly own a piece of all of them. With one click. With one single purchase, you have bought the American economy. This is the most powerful concept in modern investing. And it's the secret that Wall Street didn't want you to know for decades. They wanted you to think you needed them, the expert stock pickers, to manage your money for huge fees. But the truth is, you don't. Don't just take my word for it. Let's talk about Warren Buffett, arguably the greatest investor who has ever lived. What does he, a billionaire who built his fortune picking individual stocks, tell his own family and the average person to do with their money? He tells them to put it in a low-cost S&P 500 index fund. He was so confident in this strategy that in 2007, he made $1 million bet. He wagered that a simple, boring S&P 500 index fund would outperform a hand-picked portfolio of hedge funds chosen by a Wall Street investment firm over a decade. The so-called smart money on Wall Street, with all their experts in complex strategies, against one simple index fund. Who won? It wasn't even close. Over 10 years, the S&P 500 index fund returned an average of over 7% per year, while the expensive hedge funds only managed a measly 2.2% per year. Buffett won the bet, and the $1 million prize went to charity. The lesson was priceless. For the vast majority of people, trying to beat the market is a fool's errand. Owning the market is the path to wealth. So, how do you actually buy this? You'll typically buy it as an ETF, which stands for Exchange Traded Fund. Think of it as a basket of stocks that you can buy or sell with a single click, just like you would an individual stock like Apple. There are a few very popular S&P 500 ETFs, and they're all pretty much identical. The most famous ones have ticker symbols. That's the little abbreviation for a stock, like VOO from Vanguard, IVV from iShares, and SPY from State Street. Don't get analysis paralysis here. VOO, IVV, SPY. They all do the exact same thing. They track the S&P 500. The main difference is a tiny, tiny variation in their fees, called an expense ratio. For VOO, that fee is currently 0.03%. That's not 3%. That's 0.03%. It means for every $10,000 you have invested, you are paying Vanguard just $3 a year to manage it for you. It is practically free. So let's recap the power of this. With your first $1,000 by buying a single share of something like VOO, you are achieving 3 critical things that professional investors obsess over. 1. Instant diversification. You are not exposed to the risk of one single company failing. You are spread across 500 of the strongest companies on Earth. This is the ultimate safety in numbers. 2. Extremely low cost. You are not paying some guy in a suit 2% of your money every year to gamble with your future. Your costs are almost zero, meaning more of your money stays in your pocket working for you. 3. You are harnessing the proven long-term engine of American capitalism. The S&P 500 has historically returned an average of around 10% per year over the long run. That doesn't mean it goes up 10% every year. Some years it goes up 25%. Some years it goes down 15%. But over time, the trend is powerfully, undeniably, up and to the right. By owning this, you are betting on human innovation, on progress, and on the fundamental desire of great companies to grow and become more profitable. It is the most reliable wealth-building machine in the history of the world. So now you know the secret. The what? The single best investment for 99% of beginners is an S&P 500 index fund ETF, like VOO. It's simple, it's powerful, and it's proven. But knowing what to buy is only half the battle. The other half is actually doing it. Where do you go to buy it? What platform should you use? How do you physically open an account, deposit your $1,000, and click the buy button without getting confused or making a mistake? That's exactly what we're going to do in the next part. We are moving from theory to action. I'm going to walk you through, step by step, setting up the one type of account every investor needs. We will choose the best brokerage for you, and I will show you on my screen exactly how to navigate the interface and place your very first trade. It's time to turn that cash into a real working asset. Okay, so before you can buy a single share of any company, you have to answer a question. And this question is infinitely more important than whether you pick Apple or Microsoft or Tesla. Get this wrong and you could lose tens, even hundreds of thousands of dollars over your lifetime to a silent partner you didn't even realize you had. Get it right and you unlock a government-sanctioned cheat code for building wealth. The question is this: in what type of account will you hold your investments? You see, most beginners think investing is just about picking stocks. They download a flashy app, link their bank account and start buying. What they miss is that the account itself, the container that holds your stocks and funds, is the real foundation. And broadly speaking, you have 2 choices. You can build your financial house on regular ground, or you can build it on a special tax-proof foundation. Let's call the regular ground a standard, taxable brokerage account. It's simple, straightforward, and it's what most people think of when they hear stock market account. When you make money in this account, either from your investments growing in value or from them paying you dividends, your silent partner, Uncle Sam, gets a piece of the action. When you sell, you pay capital gains tax. When you receive dividends, you pay dividend tax. It's a constant, slow leak of value from your portfolio. But then there's the other option, the special foundation. These are called tax-advantaged retirement accounts. And they are, without a doubt, the most powerful wealth-building tools available to the average American. Instead of letting Uncle Sam take a cut every step of the way, these accounts have special rules that shield your money from taxes, allowing it to grow faster and more powerfully than it ever could in a normal account. To show you what I mean, let me tell you a quick story about 2 people. Let's call them Liam and Noah. They're identical in every way. They both just turned 25, they both have their first $1,000 ready to invest, and they both decide to buy the exact same thing, a simple S&P 500 index fund, which we'll talk about later. They are making the exact same investment. The only difference is the account they use. Liam chooses the easy path. He opens a standard taxable brokerage account. He puts his $1,000 in, buys his fund, and feels great. He's an investor. Noah does a little more research. He hears about one of these special accounts, a specific one called a Roth IRA. It takes him an extra 15 minutes to set up, but he gets it done. He puts his $1,000 in and buys the very same S&P 500 index fund as Liam. Now we hit the fast forward button. For the next 40 years, Liam and Noah don't touch their money. They let their initial $1,000 investment ride the waves of the stock market. Historically, the S&P 500 has averaged around a 10% annual return. So for the sake of our story, let's say that's exactly what they get. 40 years later, they're both 65 and ready to retire. They log in to check their accounts. That single $1,000 investment has blossomed. Thanks to the magic of compound growth, their initial $1,000 has turned into a staggering $45,259. They both stare at the same number on their screens. But this is where their paths diverge forever. Liam goes to withdraw his money. His account shows $45,259. He started with $1,000, so his profit, his capital gain, is $44,259. Because he's in a standard taxable account, his silent partner, Uncle Sam, shows up and says, "Hey, that's a nice profit you've got there. I'll be taking my cut." Assuming a 15% long-term capital gains tax rate, which is common, Liam has to write a check to the IRS for $6,638. His final take-home amount is just $38,621. He's happy, of course. Turning $1,000 into over $38,000 is fantastic. But then we turn to Noah. He also sees $45,259 in his Roth IRA. He goes to withdraw his money. And because he used a Roth IRA, a special account with a government-approved superpower, the rules are different. The money he put in grew completely 100% tax-free. When he withdraws it at age 65, the amount of tax he owes is zero. Not a single penny. He gets to keep the entire $45,259. Think about that. The exact same investment, the same time period, the same starting amount. But Noah walks away with over $6,600 more than Liam, simply because he spent an extra 15 minutes setting up the right kind of account 40 years earlier. Now, imagine this wasn't just one $1,000 investment. Imagine they invested $1,000 every single year. The difference wouldn't be thousands, it would be hundreds of thousands of dollars in free money that Noah gets to keep, and Liam has to hand over to the government. This is not a loophole. This is a gift. The Roth IRA is the single greatest wealth-building tool for new investors in the United States. The deal is simple. You invest money that you've already paid income tax on, your normal paycheck money. In exchange for that, the government agrees to never ever tax the growth on that money again. As long as you follow the rules, like waiting until retirement age to take it out, all of the growth, all of the dividends, all of the compounding for decades, it's all yours. Tax-free. So the first and most critical step in investing your first $1,000 is to open a Roth IRA. There are contribution limits. For 2024, you can put in up to $7,000 per year if you're under 50. And there are income limits, but they're quite high, and if you're just starting out, you're almost certainly well below them. For your first $1,000, a Roth IRA is the undisputed champion. Okay, so we've decided on the what? A Roth IRA. Now for the where. Where do you actually go to open one of these magic accounts? You need to go to a brokerage firm. Think of a brokerage as a special kind of bank, but instead of just holding cash, it allows you to buy and sell investments like stocks and funds. Now, you might see ads for flashy new apps with confetti and slick interfaces. I want you to ignore all of them. For your first, and possibly your forever investment account, you want to go with one of the big three time-tested, rock-solid institutions: Fidelity, Charles Schwab, or Vanguard. These are the titans of the industry. They're trusted by millions of people and manage trillions of dollars in assets. They are safe, secure, and most importantly for a new investor, they have virtually zero fees for what we need to do. Opening an account is free. There are no maintenance fees. And buying and selling the kinds of investments we'll be talking about is also free. Choosing any one of these three is like choosing between a top-of-the-line Mercedes, BMW, or Audi. They're all fantastic, and the differences are mostly a matter of personal preference. For our purposes, I'm going to recommend Fidelity. Their platform is incredibly user-friendly for beginners, their customer service is top-notch, and they have an amazing selection of low-cost investment options. So here's the game plan. You're going to open a new tab in your browser right now, or after this video, and you're going to type in fidelity.com. You'll land on their homepage. Look near the top of the page. You will see a big green button that says, Open an account. I want you to click it. A new page will load, and it's going to ask you what kind of account you want to open. You'll see a bunch of options. Don't get overwhelmed. You're looking for the section on retirement accounts, and specifically, you are going to select Roth IRA. From there, it's basically just like filling out any other online application. It's a simple step-by-step process. They will need to verify your identity, so you'll need a few things handy: your social security number, your date of birth, and your permanent address. This is all standard. legally required information to prevent fraud and comply with federal regulations. It's completely safe and secure with a firm like Fidelity. You'll click through the screens, fill in your personal details, and agree to some terms and conditions. The entire process takes about 10 minutes. At the end, you'll have an official brand new empty Roth IRA account with your name on it. Congratulations! You've just built the foundation. The final step is to fund the account, to move your $1,000 from your regular checking or savings account into this new investment account. The website will guide you. It will ask you to link your bank account using your bank's routing and account number, just like you would with Venmo or PayPal. You'll specify that you want to transfer $1,000. You'll confirm the transfer, and within 1 to 3 business days, you will see that $1,000 cash balance sitting inside your brand new Roth IRA. And that's it. You've done it. The door is open. The cash is in place. You have successfully navigated the system and set up the most powerful type of investment account available to you, positioning your money for decades of tax-free growth. Your account is open, the money is in, and you are officially on the launch pad. But what do you actually buy? How do you turn that $1,000 of cash sitting in the account into a humming working asset that builds wealth while you sleep? In the next part, we are going to pull the trigger. We will dissect the single best investment for 99% of new investors, and I will show you exactly which buttons to press to make your very first purchase. Alright, the moment of truth. You've opened the account. You've funded it with your first $1,000. That cash is sitting there, buzzing with potential like a coiled spring. And now we release it. Let's be brutally honest. Most people at this stage make a catastrophic mistake. They get seduced by the siren song of the stock-picking lottery. They hear stories on the news about a company that tripled overnight, or their buddy from college tells them about some sure-thing biotech stock that's going to cure cancer. So they take their $1,000 and they bet it all on 1 or 2 companies. They're trying to find that one single needle of a superstar stock in the giant, overwhelming haystack of the entire market. For every person who gets lucky and finds the next Amazon in its infancy, thousands more find the next Blockbuster, the next Enron, the next Sears. They watch their hard-earned money evaporate, get discouraged, and swear off investing forever, convinced the whole system is a rigged casino. They're not wrong that it's a casino, if you play it that way. But what if I told you there's a way to not just play the game but to own the entire casino? What if, instead of betting on a single needle, you could just buy the whole haystack? This isn't some secret I cooked up. This is the single most powerful piece of advice from the most successful investor in human history, Warren Buffett. For decades, Buffett, the billionaire chairman of Berkshire Hathaway, has been telling a story that every new investor needs to hear. Back in 2007, he made a public $1 million bet. He wagered that a simple, boring, low-cost S&P 500 index fund would outperform a hand-picked portfolio of hedge funds over 10 years. Now, you have to understand what a hedge fund is. These are the supposed smartest guys in the room. They're the financial wizards who charge exorbitant fees, promising their wealthy clients that they can use their genius and complex strategies to beat the market. They are the professional needle finders. And Buffett, the ultimate stock picker himself, bet against them. He bet on the haystack. For 10 years the race was on. The hedge fund managers traded frantically, buying and selling, trying to outsmart everyone. The index fund did nothing. It just sat there, passively owning the biggest companies in America. When the dust settled in 2017, the results were not just a win for Buffett, they were a knockout. The S&P 500 index fund had returned an average of over 7% per year. The hedge funds? A measly 2%. After their massive fees, some of their clients had barely made any money at all. Buffett won the bet, and the $1 million went to charity. But the lesson he gave the world was worth infinitely more. He proved on the world's biggest stage that for the vast majority of people, trying to be clever is a loser's game. The winning move is to simply own the game itself. So what is this magical investment? It's called an S&P 500 index fund. Let's break that down. The S&P 500 is simply a list of the 500 largest and most influential publicly traded companies in the United States. Think Apple, Microsoft, Amazon, Google, Johnson & Johnson, Visa. These are the titans of industry, the bedrock of the American economy. An index fund that tracks the S&P 500 doesn't try to pick which of these 500 companies will do best. Just buys all of them. When you buy a share of an S&P 500 index fund, you instantly become a part owner of all 500 of those companies. With a single click, your $1,000 is spread across the entire landscape of American business. A piece of your money is helping build the next iPhone. A piece is helping develop new medicines. A piece is helping power the servers that run the internet. This is the power of instant, effortless diversification. If one company has a bad year or even goes bankrupt, it's a tiny blip in your portfolio because you have 499 other companies picking up the slack. You are no longer betting on a single horse. You are betting on American innovation and capitalism itself. And historically, that has been the safest, most profitable bet in the world. The second reason this is the perfect investment is its ridiculously low cost. Remember those hedge funds that charged massive fees? That's called active management. Index funds are the opposite. They are passively managed. There's no genius in a suit trying to pick stocks, so there's no genius salary to pay. The fund just automatically buys the 500 companies on the list. Because of this, the fees, known as the expense ratio, are almost zero. We're talking about hundredths of a percent. An actively managed fund might charge you 1% or 2% of your money every single year. An S&P 500 index fund like the one we're about to buy might charge you 0.03%. That difference is the silent killer of wealth. A 1% fee sounds small, but over 30 or 40 years, it can consume nearly half of your potential returns. Choosing a low-cost index fund is like choosing to run a marathon in lightweight running shoes instead of heavy work boots. It gives you an enormous, almost unfair advantage over the long haul. Okay, enough theory. Let's make this happen. Let's turn your $1,000 into an ownership stake in the American economy. Pull up your brokerage account on your computer or phone right now. We're going to buy what's called an ETF or exchange-traded fund. It's just a type of index fund that you can buy and sell on the stock exchange like any other stock. The one we're going to look for is the Vanguard S&P 500 ETF. Its ticker symbol, the unique code for every stock, is VOO. V as in Victor, OO. First, find the trade button or the search bar in your app. It's usually front and center. Click it. Now in the search box, type in those 3 letters, VOO. A page will pop up for the Vanguard S&P 500 ETF. You'll see a chart showing its price, some statistics, but don't get overwhelmed. We're focused on one button. Find the big green button that says Buy. Click it. Now you're on the order screen. This is where you tell the market what you want to do. It's going to ask you a few simple questions. First, it'll ask for the order type. You'll probably see options like market, limit, stop loss. For now, we are keeping it simple. Select market order. A market order just means, I want to buy this right now at the best available price. Since VOO is traded millions of times a day, the price is fair and stable, so a market order is perfectly fine. Next, it will ask you how much you want to buy. You'll see an option to enter either the number of shares or the dollar amount. We want to invest our $1,000, so we're going to choose dollar amount. This is called buying fractional shares, and it means you don't have to worry about buying a whole number of shares. You can invest every last penny if you want. In the box, type in the amount you want to invest. Let's put in $995. We'll leave $5 in cash in the account, just as a small buffer. So type in $995. Finally, you'll see a Review Order button. Click it. This is your final confirmation screen. It will summarize everything. You are placing a market order to buy $995 of VOO. It will give you an estimate of how many shares that will get you. It all looks good. Take a deep breath. This is it. This is the moment you stop being just a consumer and become an owner. This is the moment you put your money to work for you. Go ahead. Press the button. Place order. And that's it. In the few seconds it takes for that order to go through, you have done what millions of people only talk about. You are now an investor. Your money is no longer sitting on the sidelines. It is on the field, working for you inside 500 of the world's greatest companies. You own a piece of the device you're watching this on. You own a piece of the software that delivered it to you. You own a piece of the companies that will define our future. It's a profound shift and you just made it happen. You're feeling pretty good right now. You're an owner. A capitalist. You refresh the screen and you see your position. You have officially started your journey to building wealth. But then you check your account the next day. And your $1,000 is now $985. The day after, it's $970. Panic starts to creep into the back of your mind. News channels are screaming about market volatility. Did you just buy at the absolute worst time? Did you just make the biggest financial mistake of your life? No, and absolutely not. What you're feeling is completely normal. In fact, it's the price of admission. Welcome to the emotional gauntlet that every single successful investor in history has had to run. That feeling in the pit of your stomach, that frantic urge to sell and just make the pain stop. That is the toll you pay to get on the highway to building real long-term wealth. Most people get to this toll booth, panic, and take the first exit they see, ending up right back where they started. But you're not going to do that, because you're going to understand something that they don't. You're going to understand the crucial difference between volatility and risk. Volatility is the price of the stock bouncing up and down. It's the daily noise, the headlines, the $30 drop in your $1,000 investment. It feels terrible, but it's just movement. It's like turbulence on an airplane. It's uncomfortable, it might make you spill your drink, but it doesn't mean the plane is crashing. Risk, on the other hand, is the chance of the plane actually crashing. It's the permanent loss of your money. And the single biggest secret that wealthy investors understand is that the only thing that turns temporary volatility into permanent risk is your own reaction to it. It's hitting the panic button and ejecting from a perfectly good plane just because of a little turbulence. Let me tell you a story. A very recent story that I want you to burn into your memory. Let's travel back in time to February of 2020. The stock market was roaring. It was hitting all-time highs. People who had invested felt like geniuses. It seemed like the party would never end. And let's imagine you, our new investor, finally decided to jump in. You took your $1,000, you bought that S&P 500 index fund, and for a few days you felt great. You were officially an investor. And then the world changed. A virus, once a distant headline from another continent, was suddenly everywhere. The word pandemic entered our daily vocabulary. Countries started locking down. Businesses were forced to close. For the first time in modern history, the entire global economic engine shuttered and seized. And the stock market, which is supposed to look 6 to 12 months into the future, couldn't see anything but a black hole of uncertainty. What followed was the fastest, most brutal stock market crash in American history. Faster than 1929. Faster than 2008. In just over a month, the market plummeted by more than 30%. Now put yourself back in your shoes. Your brand new $1,000 investment, your symbol of a brighter financial future, is suddenly worth $700. Maybe even less. Every single day you open your app, the number is a deeper shade of red. The news isn't just whispering about volatility anymore. It's screaming about a new Great Depression. Financial pundits with decades of experience are on TV with fear in their eyes, saying things like, "This time is different." Your friends, your family, they're all telling you, "You need to get out. Sell what you have left before it goes to zero." Every single instinct in your body, the primal ancient part of your brain designed to flee from danger, is screaming at you to sell, to cut your losses, to just stop the bleeding. And millions of people did exactly that. They sold. They logged into their accounts, hit the button, and turned that temporary on-paper loss of $300 into a permanent real-world loss. They locked it in. They took their $700 and ran for the hills, vowing never to trust the stock market again. They let the turbulence convince them the plane was going down. But what happened to the people who did nothing? The people who felt the exact same fear, the same gut-wrenching panic, but who simply held on? What happened to the people who were even crazier, the ones who saw the sale of a lifetime and kept buying on the way down? Well, what happened next was something nobody predicted. Bolstered by unprecedented government stimulus and the sheer resilience of the American economy, the market didn't just stop falling. It turned around. And it didn't just turn around, it rocketed upwards with a ferocity that left everyone breathless. By August of 2020, just 5 months after hitting rock bottom, the stock market had recovered every single penny it had lost and was already setting brand new all-time highs. The people who sold at the bottom for $700 watched in horror from the sidelines as their investment, had they just left it alone, would have climbed back to $1,000, then $1,100, then $1,200 and beyond. They didn't just lose $300. They lost the entire recovery and all the gains that followed. They paid the toll, but they never got to drive on the wealthy highway. They experienced all of the pain for none of the gain. This isn't some ancient history lesson. This was just a few years ago. And it is the single most powerful illustration of the most important mantra in investing. It is time in the market, not timing the market, that builds wealth. Trying to time the market, trying to sell at the top right before a crash and buy back in at the bottom, is a fool's errand. Nobody can do it consistently. Not the hedge fund billionaires, not the so-called gurus on TV, and certainly not us. It's a game you are guaranteed to lose. But you don't have to play that game. Your advantage as a regular investor isn't being smarter than everyone else. It's being more patient. It's understanding that the price of the incredible long-term growth of the stock market is that you have to be willing to sit through these terrifying, but ultimately temporary declines. Let me hit you with a statistic that should stop you in your tracks. According to analysis by JP Morgan, if you had invested $10,000 in the S&P 500 at the beginning of 2003 and just left it alone for the next 20 years, until the end of 2022, your $10,000 would have grown to over $64,000. A fantastic return. But what if you tried to time the market? What if, in your attempt to avoid the worst days, you missed just the 10 best days of the market over that entire 20-year period? Just 10 single days out of more than 5,000 trading days. Your $64,000 return would plummet to just $29,000. You would lose more than half your potential gains by missing just 10 days. Gets worse. If you miss the 20 best days, your return drops to just $16,000. Miss the 30 best days and you're down to $9,900. You would have actually lost money. And here is the absolute kicker. Where do you think those best days occur? They don't happen on calm, sunny, predictable days. The market's best days almost always happen right in the middle of a crisis, often within days of its absolute worst days. They happen when fear is at its peak, when the news is at its most dire, and when most people have already panicked and sold. So, the very act of selling to avoid the pain makes it almost statistically certain that you will miss the explosive recovery that follows. You are playing a losing game. The only winning move is not to play. So when your $1,000 becomes $970, you need to see it for what it is. It's not a mistake. It's not a sign you did something wrong. It is the cost of doing business. It's the market shaking the tree to see who falls out. Your job is to hold on tight. Your job is to remember that the real enemy isn't the number on the screen going down. The real enemy is the voice in your head telling you to panic. It's that lizard brain, hardwired for immediate threat response, that is completely unequipped to handle the abstract world of long-term investing. The entire game is not about picking the perfect stock or predicting the next crash. The entire game is about mastering your own psychology. It's about building a system and a mindset that protects you from your own worst instincts. It's about automating your success so that when the next storm hits, and trust me, there will always be a next storm, you can sail right through it instead of abandoning ship. So if the market swings aren't the real danger, and our own panic is the true enemy, how do we build a fortress around our investments to protect them? From ourselves? There's a simple, almost boring strategy that turns this emotional weakness into your single greatest strength. And it's the secret weapon of nearly every successful long-term investor. It's called dollar cost averaging. And I know it sounds like something your boring uncle would bring up at Thanksgiving, but I promise you, this is the key that unlocks everything. It's the simple mechanical process of investing a fixed amount of money at a regular interval, regardless of what the market is doing. That's it. It's not sexy. It doesn't involve hot stock tips or complex charts. It's the financial equivalent of brushing your teeth. You don't check the news to see if it's a good day for dental hygiene. You just do it. Because consistency, not genius, is what builds wealth. Let's break this down. Imagine you have your $1,000 ready to go. The old you, the emotional you, would be paralyzed. Is the market too high right now? Should I wait for a dip? What if I buy today and it crashes tomorrow? This is financial quicksand. You're stuck, and the longer you wait, the more you sink into inaction. Dollar cost averaging pulls you out. Instead of investing that $1,000 all at once, what we call a lump sum, you decide to invest $100 every single month for 10 months. Now let's watch what happens. In month 1, let's say your chosen S&P 500 index fund, VOO, is trading at $100 per share. Your $100 investment buys you exactly 1 share. Simple enough. But in month 2, the news is terrible. There's a panic, fear is everywhere, and the market drops. VOO is now trading at $80 per share. The emotional investor is freaking out. Their first investment is already down 20%. They're thinking about selling, about cutting their losses. But you? You're not an emotional investor anymore. You're a mechanical investor. It's the second month, so your automated system invests another $100. But this time, because the price is lower, your $100 doesn't buy 1 share. It buys 1.25 shares. Let's pause here. This is the magic. When prices go down, your fixed dollar amount automatically buys more of the asset. In month 3, the sky is falling. Pundits on TV are screaming recession. Your fund drops to $50 per share. Your portfolio looks like a crime scene. The emotional investor has already sold everything and sworn off the stock market for life, locking in their losses. But your system, your beautiful, unfeeling automatic system, kicks in again. It invests another $100. And at $50 a share, that buys you 2 full shares. In just 3 months of a terrifying market crash, you've invested $300 and you now own a total of 4.25 shares. Your average cost per share isn't $100. It's not $80. It's not even the average of the 3 prices. It's the total amount you invested, $300, divided by the total shares you own, 4.25. Your average cost is now just over $70 per share. While everyone else was panicking, you were systematically lowering your cost basis, getting a better and better deal each time the market fell. Now let's say in month 4, the market starts to recover. The price jumps back to $80. Your 4.25 shares are now worth $340. You've invested $400 total, but you're almost back to even, and you own way more shares than if you had just bought at the top. When the market eventually recovers back to $100 per share, that emotional investor who bought 1 share and then panicked is just back to where they started. You, on the other hand, with your 4.25 shares, will have a portfolio worth $425. You turned the market's greatest fear, a crash, into your greatest advantage. Dollar cost averaging completely reframes your mindset. A market dip is no longer a crisis. It's a sale. It's a Black Friday event for the world's greatest companies. You get to buy a piece of Apple, Microsoft, and Amazon at a discount. This single psychological shift is the difference between someone who quits after 3 months and someone who builds a 7-figure portfolio over 30 years. But what if the market just goes up? What if you start investing and it's a raging bull market? Well, your $100 will buy you slightly fewer shares each month as the price increases. And some academics in an ivory tower will tell you that, statistically, investing a lump sum all at once has outperformed dollar cost averaging about 2/3 of the time in history. And they are technically correct, because the market, over the long term, tends to go up. So the sooner you can get all your money in, the better. But here's what their spreadsheets and backtests don't account for. Human emotion. The biggest risk for a new investor isn't math. It's fear. Imagine you put your entire first $1,000 into the market on a Monday, and on Tuesday it drops 15%. How would you feel? You feel like a fool. You'd feel like you made a terrible mistake. And there's a very high chance you would sell at the bottom and never invest again. That is the catastrophic failure we are trying to avoid. Dollar cost averaging is your psychological armor. It's the training wheels on your investing bicycle. Smooths out the ride. It gets you used to the ups and downs of the market without giving you the full gut-wrenching volatility of a lump sum investment. It automates good behavior. You set it up once, a recurring transfer from your bank to your brokerage, a recurring investment into your chosen fund, and you let the system do the work. You've removed the single biggest point of failure in the entire investing process. You no longer have to decide if it's a good time to buy. The decision is already made. It's the first of the month. That's the time to buy. End of story. This is how you build the fortress. You're not trying to outsmart the market. You are simply creating a system to outsmart your own worst instincts. You're accepting that you cannot predict the future, and instead, you're building a strategy that benefits from that uncertainty. Whether the market zigs up or zags down, you're buying. You're accumulating. You're building your position piece by piece, month by month. So for your first $1,000, the plan is simple. Don't throw it all in at once. Break it up. Maybe it's $100 a month for 10 months. Maybe it's $50 every 2 weeks for 10 months. The exact amount and frequency don't matter as much as the consistency. Pick a schedule you can stick to, set up the automation in your brokerage app. It literally takes 5 minutes, and then walk away. Let the system do its job. This disciplined, unemotional approach is what separates amateurs from serious wealth builders. You now have the what, a diversified, low-cost index fund. And you have the how, the automated, disciplined strategy of dollar cost averaging. You have a plan that not only works mathematically, but more importantly, works behaviorally. It protects you from fear when the market is falling, and protects you from greed when the market is soaring. But there's one final, critical piece of this puzzle. It's the container you hold all of this in. Because you can have the perfect investment and the perfect strategy, but if you put it in the wrong type of account, you could be setting yourself up to give away tens, or even hundreds of thousands of dollars of your hard-earned growth to the IRS. There is a government-sanctioned cheat code, account designed specifically for investing, one that can allow all of your growth, every single penny, to be 100% tax-free forever. And choosing the right one is the final step in building your untouchable financial fortress. This secret code account isn't some offshore loophole or a trick reserved for the ultra-wealthy. In fact, it was created by the United States government itself, and it has a name. It's called a Roth IRA. And I know what you're thinking. IRA? Isn't that some boring retirement thing for old people? And that is exactly what the system wants you to think. They give it a dull bureaucratic name so your eyes glaze over and you just keep your money in a regular account where they can get their cut year after year. But you're not going to do that, because you're going to understand the earth-shattering power of this account. Imagine you and your friend both decide to plant a lemon tree. You each have one single seed. The government comes to you and says, "Hey, we need to tax that seed. It'll be a few cents." You pay the tax. Your friend, on the other hand, gets a different deal. The government tells him, "Don't worry about the seed. You can plant it for free. We'll just come back in 40 years and take a third of your entire lemon grove." Which deal would you take? It's a no-brainer, right? You'd pay the tiny tax on the seed to keep the entire grove for yourself. That seed is your $1,000. The tax on the seed is the income tax you already paid on it before you got your paycheck. The Roth IRA is you planting that after-tax seed. A traditional 401k or a traditional IRA is your friend planting the pre-tax seed. For the next 40 years, both of your trees grow. They sprout branches, blossom, and produce an unbelievable amount of fruit. Finally, at retirement, you go to harvest your lemons. You get to keep every single one. 100%. Your friend goes to harvest his, and a truck pulls up. The government steps out and says, "All right, time to pay up." And they drive away with a third of his entire life's work. He's left with a fraction of what he grew. You are left with everything. That is the difference. The Roth IRA lets you pay a tiny bit of tax today on the small seed, so you never have to pay a single cent of tax on the massive tree of wealth you grow over a lifetime. Let's stop talking about lemons and start talking about dollars. Real dollars. Your dollars. You take your $1,000 and you put it into a broad market index fund like the ones we talked about inside of a Roth IRA. You don't touch it. You just let it sit there for 40 years. Based on the stock market's historical average return of about 10% per year. Do you know what that $1,000 becomes? It becomes over $45,000. Now, if that money were in a normal taxable brokerage account, when you go to pull it out, you'd owe capital gains tax. Let's be conservative and say that's 15%. You would immediately write a check to the government for nearly $7,000. Your $45,000 is suddenly $38,000. But because you were smart, because you used a Roth IRA, you owe nothing. Zero. The full $45,000 is yours to keep. Now multiply that effect. You're not just investing $1,000 one time. You're going to be adding more over the years. Imagine you add just $500 a month. Over that same 40 years, you would have contributed a total of $241,000 of your own money. But thanks to the magic of compound growth, your account wouldn't be worth $241,000. It would be worth over $2.6 million. And if that were in a traditional 401k or a regular brokerage account, your tax bill could easily be over $500,000. Gone. Vanished from your life savings. But in a Roth IRA, your tax bill is zero. You keep all $2.6 million. That one decision, the decision to use a Roth IRA instead of a regular account, is literally a multi-million-dollar decision over a lifetime. It is the single most powerful wealth-building tool available to the average American, and it's hiding in plain sight. So what's the catch? There's always a catch, right? Well, not really a catch, just a few rules you need to know to play the game. First, the government limits how much money you can put into this golden ticket account each year. For 2024, that limit is $7,000 if you're under 50. This isn't a bug. It's a feature. It creates urgency. You get one shot per year to use that contribution space. If you don't use it, it's gone forever. You can't go back and make up for last year. This is why starting now, even with just $1,000, is so critical. You're not just investing $1,000. You're claiming a piece of your 2024 tax-free growth allocation that you will never get back. Second, there are income limits. If you make too much money, the government actually stops you from contributing directly to a Roth IRA. For a single person in 2024, that limit starts to phase out around $146,000 a year. This is another reason to start now. This account is designed for people on their way up. By the time you're a high earner, the front door might be closed. You need to get in now while you can and let that money start compounding in its tax-free fortress. The third rule is about withdrawals, and this is where most people get confused, but it's also where the Roth IRA has a hidden superpower. The general rule is that to take out your earnings, the growth, the profit completely tax and penalty-free, you need to be at least 59.5 years old and have had the account open for at least 5 years. This is what makes it a retirement account. It's designed to stop you from raiding your future self's nest egg. But here is the secret that almost nobody talks about. You can withdraw the money you personally put in, your original contributions, at any time for any reason, with absolutely no tax and no penalty. Let me repeat that because it's a game changer. The money you put in is never locked up. If you put in your first $1,000 today, and next year you have a major emergency and you absolutely need that cash, you can pull that $1,000 right back out. No questions asked, no forms to fill out, no penalty. It's your money. This makes the Roth IRA an unbelievably flexible tool. It's like a high-yield savings account and a supercharged investment account fused into one. Your contributions are always accessible, while your earnings are protected in a tax-free bubble, growing and compounding for your future. It gives you peace of mind and incredible power simultaneously. So how do you get one? It's astonishingly simple. Those same brokerages we discussed, Fidelity, Vanguard, Charles Schwab, they all offer Roth IRAs. When you go to their website to open an account, instead of clicking Open a Brokerage Account, you simply click Open an IRA, and then you select Roth IRA. That's it. The process takes about 10 minutes. You're not buying a different product. You're just choosing a different type of container for your investments. You're choosing the tax-free container instead of the taxable one. You now have all the pieces to construct an unstoppable financial engine. You know that the stock market isn't a casino. It's a wealth creation machine. You know that you don't need to pick individual stocks. You can own the entire market through a simple low-cost ETF. You know where to open an account with a trusted low-cost brokerage. And now you have the master key. The knowledge of the Roth IRA, the account that will shield your wealth from taxes forever, allowing you to keep every last dollar you earn. You have the blueprint. You have the tools. You've built the vault. The final question, the one that ties it all together, is what specifically do you put inside? With your $1,000 sitting in your brand new Roth IRA, what is the one investment you should make? Choosing the right ETF is the final step. It's the decision that activates everything we've just learned. And in the final part of this guide, we will give you the answer. We will show you the exact type of fund that can serve as the bedrock of your entire financial future. The one investment you can buy with your first $1,000 and potentially hold for the rest of your life. It's called an index fund. Specifically, a low-cost S&P 500 index fund. And I know what you might be thinking. That's it? That's the big secret. And the answer is yes. Because the most profound truths in finance are often the simplest, and the most powerful strategies are the ones that are boringly effective. To understand why this one simple idea is so revolutionary, let me tell you a quick story about a 10-year, $1 million bet. It's a story about the single greatest investor of all time, Warren Buffett, versus the supposed smartest guys on Wall Street. Back in 2007, Buffett made a public wager. He bet that over the next decade, a simple, unmanaged, low-cost S&P 500 index fund would outperform a hand-picked portfolio of hedge funds. Now, hedge funds are the playground of the ultra-rich. They're run by financial wizards with PhDs from MIT and Harvard, using complex algorithms and secret strategies, and they charge astronomical fees for their supposed genius. They represent the absolute peak of active, hands-on investing. So who took the other side of the bet? A company called Protégé Partners, a firm that invests in, you guessed it, hedge funds. They carefully selected 5 of the best hedge funds they could find, believing their star managers would easily crush a simple, dumb index fund. The prize? $1 million for charity. The race began right before the 2008 financial crisis. It was the ultimate test. Could the so-called experts navigate a crisis better than the market itself? For the first year, as the market crashed, the hedge funds did slightly better. They lost money, but they lost less than the index fund. The experts were patting themselves on the back. They were justifying their high fees. But then the market started to recover. And as it recovered, a fascinating, and for the hedge funds, a horrifying trend emerged. Year after year, the simple, boring S&P 500 index fund just kept pulling ahead. There were no genius managers, no secret trades, no complex derivatives. It was just a fund that automatically bought and held the 500 largest public companies in America. While the hedge fund managers were frantically buying and selling, trying to outsmart everyone, the index fund was just sitting there, patiently harnessing the raw collective power of American business. By the time the 10-year bet concluded at the end of 2017, the results weren't just clear, they were devastating. The hedge funds chosen by the experts had returned an average of 2.2% per year after fees. The simple S&P 500 index fund? It returned over 7% per year. The hedge funds turned a hypothetical $1 million investment into $1.2 million. The index fund turned it into $1.85 million. It wasn't even close. Warren Buffett won the bet, and he did it by championing an investment vehicle that is available to every single one of us. So what is this thing really? An S&P 500 index fund is not a stock. It's a basket that contains a tiny piece of 500 of the most dominant companies on Earth. When you buy a share of an S&P 500 fund, you instantly become a part owner of Apple, Microsoft, Amazon, Google, Nvidia, Tesla, Johnson & Johnson, Visa, and hundreds more. You're not betting on one company to succeed. You're betting on the American economy as a whole to continue to grow, innovate, and create value over the long term. It is the definition of diversification. If one company in the index fails, it eventually gets replaced by a new, more innovative company. The index is self-cleansing. It's designed to own the winners and cut the losers automatically, without you ever having to lift a finger. The best way for a new investor to buy this basket is through something called an ETF, or an exchange-traded fund. Think of it as a modern, more efficient version of a mutual fund. You can buy and sell it throughout the day just like a regular stock, right from your brokerage app. And most importantly, the best ones have incredibly low fees. This fee is called the expense ratio. It's the tiny percentage the fund company charges each year to manage the fund. For the hedge funds in Buffett's bet, these fees were often 2% or more. For the top S&P 500 ETFs, the expense ratio can be as low as 0.03%. That's not a typo. For every $1,000 you have invested, they're charging you just 30 cents per year. The reason the fees are so low is because there's no genius manager to pay. The fund is run by a computer that simply mirrors the S&P 500 index. It's the ultimate proof that you don't need to pay a fortune for stellar long-term performance. So, how do you actually do it? You've got your $1,000 in your newly opened brokerage account. Now you just need to find the fund. You do this by searching for its ticker symbol, which is like a stock's nickname. Some of the largest and most respected S&P 500 ETFs have tickers like VOO, from Vanguard, IVV, from iShares by BlackRock, and SPY from State Street. These are the big three. They all do essentially the same thing. Track the S&P 500. Their performance is virtually identical. The main difference is tiny variations in their expense ratios. For a beginner, any of them is an outstanding choice. Another fantastic option is a total stock market ETF like VTI. The idea is very similar, but instead of just the 500 largest companies, it holds a piece of nearly every publicly traded company in the US, over 3,000 of them. It's even more diversified. The long-term performance is very similar to the S&P 500, so you can't go wrong with either. So you pick one. Let's say you You type VOO into the search bar of your app. You'll see its current price per share. Let's say it's trading at $450 a share. With your $1,000, you can buy 2 full shares, which would cost $900, and you'd have $100 left over. Or, if your brokerage offers fractional shares, which most good ones do, you don't even have to think about it. You just say, I want to invest $1,000 in VOO. And the platform will automatically buy you the exact corresponding amount, which in this case would be about 2.22 shares. You click buy. You confirm the trade. And that's it. Congratulations. You are now officially an investor. You are a part owner of the American economy. Take a moment to let that sink in. With a few clicks on your phone, you have put your money to work in a way that, historically, has been one of the most powerful wealth creation engines in human history. But here's the most important part of this entire guide. Your journey does not end here. In fact, it has just begun. Buying this first investment is step 1. The secret to building real life-changing wealth is what you do next. And what you do next is 2 things: you automate and you wait. First, you automate. Go into your brokerage settings right now and set up a recurring investment. Could be $50 a month, $100 every 2 weeks, whatever you can afford. The amount is less important than the consistency. By setting up an automatic transfer and investment, you are paying yourself first. You are putting your financial future on autopilot. You're buying more shares when the market is up, and you're buying more shares when the market is down. This strategy, called dollar cost averaging, removes emotion from the equation and ensures you're consistently building your position over time. Second, you wait. And this is the hardest part. The stock market does not go up in a straight line. There will be days, weeks, even years where your account balance goes down. You will see red. You will feel that knot in your stomach. The news will scream about recessions and market crashes. Your brain, your friends, your family, everyone might be telling you to sell, to get out before you lose more. This is the great filter. This is where most people fail. They buy high, fueled by greed, and they sell low, crippled by fear. The secret to winning is to do nothing. It's to remember the story of Buffett's bet. It's to trust in the long-term resilience and growth of the world's greatest companies. It's to see a market downturn not as a crisis but as a sale. It's a chance for your automatic investments to buy shares at a discount. Your first $1,000 is not a lottery ticket. It is a seed. You have not just bought a stock. You have planted a financial tree. And that tree will not grow to provide shade overnight. It will be battered by storms and droughts. But if you protect it from your own fear, if you continue to nurture it with consistent contributions, and if you give it decades to grow, it can become something magnificent. What you've done today is more than just an investment. It's a declaration. It's you telling yourself that your future is worth investing in. It's the first step away from living paycheck to paycheck and toward a life of financial freedom. It's about buying back your time, your most precious asset, one share at a time. This is how you win. Not by being the smartest person in the room, but by being the most patient and the most disciplined. Welcome to the journey.